So welcome everyone to today's session on the federal budget impact of SMSFs. My name's Aaron Dunn, and of course I'm joined by my co-host, our Technical and Education Manager at Smarter SMSF, Tim Miller. G'day Tim, how are you?
Yeah, going well, Aaron. How are you doing?
Very well, thank you. Well, I think to sum up, when we looked at the topic of SMSFs on federal budget night, the quick control find on super and SMSFs came up with some very low numbers, and ultimately, our initial view was potentially that means we have a quiet night, but it's probably fair to say that's not how it panned out.
No, that's correct. And look, to be fair, when I did that control F5 or whatever, I came up with 171 searches. I thought, wow, this is massive, but they were all in the budget proposals. And every time I just mentioned the word superannuation, and I reckon that was 160 of them. So it did look quiet, but it was really in the devil was in all the other detail for us that made it what we feel to be quite a significant budget for self-managed superannuation funds.
Yeah, so let's sort of get stuck into this, because today, as we've sort of set out here at the very beginning, it wasn't a super budget as such. And a lot of the discussion, and most of you will be well aware of the fact that there are some very substantial changes around tax reform to capital gains tax, the way in which negative gearing is going to work, how it applies to family trusts. But the fact that in a lot of these instances, the exclusion to superannuation opens up the fact that these areas put a much greater focus and attention to the topic of super, and then more specifically SMSFs. So what we're going to really try and help you to understand today is what this conversation now needs to start to look like with your clients when we look at the impact of these particular measures. Your clients, no doubt, are already coming to you and asking questions of, family trusts and what we should be doing here, and what does it mean from a capital gains tax point of view in respect to assets that we hold and whatever. So we've done a little bit of modelling around these things. Of course, it's very early days. We don't have legislation on many of these topics. So a lot of this stuff at the moment, we are using our own knowledge and understanding of how this is going to work, and giving you some information ultimately that you can have conversations with your clients at this time without sort of shooting off until we actually have law in place. And Tim, I think ultimately when we think about this, we were always destined to see reforms happen at this point in time, and not necessarily off the back of superannuation, and that we saw super ultimately excluded here. But the reality is we did ultimately see changes, which we saw changes a decade ago and then changes a decade before that.
Yeah, and look, there was certainly synergy about it, isn't it? I mean, look at that, all this. No, I don't even want to say it. I don't understand it, but I want to say all the sixes and sevens there. But the concept of what we saw 20 years ago, and then subsequently 10, and now is that we see major reform every decade. Once a decade, and we've had to do the heavy lifting for two of those decades in the super space, with the simpler super / better super reform of 0607, really rewriting the whole handbook on super, and then the introduction of the transfer balance cap. It was interesting to see that this is the most probably significant from a tax change point of view, that tax change probably has as much impact on super as those other reforms does as some of the changes that were introduced in either of those two previous budgets.
Yeah, and I think the interesting one here is you look at the bottom from a policy point of view, the fact that you go back to 6-7, that 06-07 period, and we did see a government going through significant periods of surplus. So then that was kind of being redistributed in to the point of where we are now, where the budget deficits for the next 4 years are projected to, obviously further the level of debt that we have in this country. So how times change over that 20-year period, and therefore we're seeing ultimately the impact of this now with these measures. But again, I think it's worth highlighting here where the things didn't change for clients, and this really comes back to the fact that super will become that vehicle of choice. So CGT doesn't change. The fact that we have our 1/3 discount for superannuation funds is preserved. And the fact that we also have the difference between accumulation and pension phase being retained, again, means that people will look to superannuation to take advantage of that rather than the indexed approach. We see no change to the income tax rates that are attributable inside superannuation, and the fact that our exempt current pension income will continue to operate. The property rules that have been talked about around residential property, new builds versus existing builds and commercial properties and so forth, none of that changes in the SMSF landscape. And even to the extent where there was some concerns flagged around limited recourse borrowing arrangements being taken off the table as part of this sort of housing approach, the LRBA rules have very much remained intact. So, and I think, Tim, the other one that's probably worth noting here is we've continued to see our contribution caps increase at a far faster rate because of both wages growth and inflation and the rate of inflation. And we've now got some fairly large opportunities to get money into super. So, could the government have tried to pull some levers there? But again, a lot of that sort of opportunity to get money into super. And we're talking, if we looked at it now between June in essence and the 1st of July, in a coupled situation, you're going to be getting over $1 million of NCCs into superannuation, which is a pretty significant amount.
Yeah, and I think if you look at, Aaron, if you go back to that middle reform, the 16-17 reform, and we saw the introduction of the transfer balance cap at 1.6 million, to think that less than, effectively 10 years later, that we're $500,000 up on that cap alone, and then the non-concessionals have grown slowly to start with, so concessionals and non-concessionals slowly, as you highlighted, but now for them to move into 130, you're right, it's close enough to $400,000 a year per person if they've got less than that 1.84 or whatever the number is. I think it's 1.84 million, which means for a couple, the opportunity to pump $1 million into super, which was a long lost dream from the 06-07 reforms, the opportunity to pump $1 million between two can be done over a relatively short time on ever increasing balances, and just I think we worked it out there, and we can be wrong with these numbers, but we're probably going to see indexation every couple of years at least now. Certainly at the general transfer balance cap with inflation, but the contributions as well, which really makes us rethink all our strategies around contributing money.
Yeah, absolutely. Well, let's get stuck into the first one, Tim, because this new tax cut for workers, and you kind of think, well, where does this tie it back into superannuation? But of course, that's what we do. That's part of our job. And one of the things that we've obviously identified is to revisit things like salary sacrifice arrangements, and in particular, things like transition to retirement. So I might get you, Tim, to just put some commentary around this and what it might mean strategically with some of our superannuation clients.
Yeah, look, I think straight off the bat, what we will say is that for our low income earners, so for those under the $45,000, we've now got for the 26-27 year, we've got parity between tax on money going into super versus tax outside super. So there's the concept, obviously, that money inside super doesn't provide you any benefit if you're a low income earner. And of course, the government themselves have addressed that by enhancing, albeit we have to wait a further year, but enhancing the listo payment, right? So effectively the removal of that contributions tax for those earning less than that $45,000. Now, of course, it's currently set at $37,000, so we've got to hold it out for one more year. But from the 27-28 year onwards, we get the increase to the threshold. There's no mechanics behind the calculation. Everybody gets the 810 back right up to $45,000. So you're basically getting a rebate on whatever tax is paid on the SG contributions within the fund. They're up to that maximum of 810. So there's a lot of opportunity. So when we talk about things like salary sacrifice, it's not within scope of anybody on the lower tax bracket to be looking at salary sacrifice arrangements. But where there is benefit is anybody that's over and above that $45,000 to look at the concept of, okay, well, am I better off bringing myself back into, from a personal tax point of view, into that lower tax bracket and having the money taxed in super to the equivalent level? So if I'm earning 50,000, 60, 70, whatever the number might be, is there benefit in salary sacrificing that and paying only 15%? And whilst for a lot of people the answer will still be no, there's this niche group of clients, which is our 60 to 65-year-olds who are in that transition to retirement strategy opportunity, where they will be able to offset marginal tax, because if they start to draw down from super, they're paying no tax on those drawings. Yes, they're still paying tax on the earnings inside of super, but you're effectively rebalancing your super with the contributions and only ever paying at maximum tax rate of 15%. So the salary sacrifice plus TRIS strategy for anybody earning above 45,000 still has significant relevance, particularly for those with the total super balance less than 500,000 who can utilise the unused carry forward amount from the preceding 5 years to top up their caps to whatever level.
Yeah, and I think that's the really important characteristic here is that where you identify clients that have those balances under the 500,000 and they, in essence, haven't utilised that available cap space to them in those years, you can very easily see the tax arbitrage that they get off the back of being able to take tax-free benefit payments to them in that first instance. So you can see on that previous slide we spoke, or on this slide, I should say, the fact that we're seeing that increase to the effective tax-free threshold through that working Australian tax offset. So this is something that we will continue to see some opportunities exist for clients once they reach that preservation age of age 60 to explore whether transition to retirement is beneficial. I think, Tim, even it's worth remembering that, again, we've seen the concessional cap move from 25 slowly and then 32.5 and going up. And this is where, again, it's becoming, the more that we get with that concessional contribution cap, the more attractive year on year that salary sacrifice through the TRIS strategy becomes beneficial from a compounding point of view until they reach age 65 or ultimately retire.
Yeah, and probably the other point I'd add here, and whilst we're talking salary sacrifice and TRIS, for example, a lot of the people in this category are not necessarily going to be impacted by things like Division 296, right? But we always have to keep an eye on Div 296 for a lot of our strategies as we move forward. And what this also lends itself to is the concept of creating separate interests, and creating separate interests then creates separate opportunities from an estate planning point of view, tax-free benefits versus taxable benefits. It also allows for contribution splitting, so salary sacrifice, contribution splitting, money going in, and then that money moving across to the other spouse. And with the discretionary trust changes, here's a way of moving money from one person to the other legitimately through the use of superannuation. So there's so many angles that when we view tax and super collectively, there's so many opportunities that exist. And whilst they're available in other super formats, they're a lot simpler when the structure is all handling the whole process in the self-managed super fund space.
Yeah. All right, well, let's keep moving. So let's get stuck into one of the key measures, which was, of course, around CGT reform. So as we know, the government has indicated that we're going to see the 50% discount removed for assets that were acquired effectively after budget night and back to the future. So we are going back, in essence, to that CPI adjusted cost base and therefore paying tax on the real gains, having adjusted for any inflationary impact. The other thing, however, is that we note that there's that 30% minimum tax that applies to the inflation adjusted gain, but we should note that there will be some exemptions around people that are in receipt of government supported benefits. And Tim, I think the interesting one there will be, if clients are looking to sell at a later period of time, there will be that discussion about whether they will qualify in part for, say, age pension entitlement to ensure that they may not be subjected to that 30% minimum tax rate.
Yeah, and I've certainly already, and we had some discussions the other day, and I've seen some additional commentary around in regards to, is this a way of Australians starting to look more seriously at lifetime annuities and other products out there to be able to qualify and tying up a certain amount of capital into such products to qualify, because there's very few products out there that provide the asset test exemption like the old days, but there are still some that provide benefits. And so that certainly will be interesting from a sell down strategy point of view, is where people sit and their ability to qualify, obviously, where they sit with regards to being able to access those government benefits. And of course, your comment made me laugh. The Back to the Future comment with indexation. It seems that all these reforms, Aaron, do seem to take us back there in the end, don't they? Because the transfer balance cap took us straight back to RBLs, but just with a different name. So at least with indexation, they're taking us back to the actual rules that were in place at a point in time.
Yeah. And I think what is worth obviously noting as well there is that the only time in which that discount is really going to continue, but for superannuation funds, is of course around the new residential property. So this is a key pillar to Labor's policies to try and open up housing opportunities. So there is that eligibility to give consideration to either method based upon whatever provides that better outcome. So again, it's important to understand that these CGT discount reforms don't apply to superannuation funds. So again, that CGT 1/3 discount is still relevant, and the ECPI stuff that we spoke about as well. So Tim, I guess, how does this now look when we start to compare the structures here? Because I think what's interesting is when you start to look at these, a lot of these really now have very similar alignment to the way in which the tax rate is ultimately applying.
Yeah, and I think because we're gonna head down this path in a moment and talk and incorporate Division 296 into the conversation a little bit more. I think if we look at these changes from a pure existence where Div 296 doesn't exist, right? Then what we can see is that on the CGT stuff alone, there is this real focus on particularly self-managed super funds and super, but being far more tax effective, right? Now that's on top of the fact that it was already far more tax effective when you're in pension phase. So anybody with less than the general transfer balance cap, where you're paying 0% on earnings, 0% on drawdown, and 0% on capital gains. I mean, there is no better tax rate than that. We understand that, but the fact that now, from an individual point of view, you lose that 50% discount, but more importantly, and I think this is where we're going to head in a moment, the family trust, the discretionary trust piece is probably as significant, if not more significant, than the capital gains changes that are coming in, because it changes the way that a lot of people need to structure things from an income distribution point of view if they're not going to get the additional tax benefits. So, when we look at, and we'll talk about negative gearing again in a moment as well, but if we work down the sort of the scale there, it just highlights what we already knew, but we started to question in light of Div 296. And I think we're going to do some work in today's session just to highlight that, maybe things aren't as bad as they appear in the new world of Div 296 as well.
Yeah, so there's probably a good opportunity here, Tim. There's a couple of questions that's come through. So Eleanor, when does the choice re-residential property have to be made? I guess that's not defined as such, but you would assume it would be at the point in time when that asset would be sold. So that wouldn't be any change to what we've seen historically. where there was a choice in methodology between those two. And I think the other one here from Anonymous, but just to clarify, when an age pensioner or with an age pensioner, if they dispose of an asset on the basis that therefore they're in receipt of income support, they are not eligible for the discount, but it ensures that the 30% minimum tax rate isn't being applied, but rather if their tax rate is less than 30%, you would then apply that tax rate to that. So it is important to note that the discount wouldn't be relevant on a post-test time, so post-budget asset that was acquired. We would need to look at the differences of subject to when that has been acquired, because of course the government has even included timings of pre-20 September 1985 assets there. But it is important to note that if it was a post-test time acquisition, it would be subject to the indexation rate, but it's the 30% min tax that would be excluded where they are an income recipient.
Yeah, Aaron, if I could just, I guess, just to highlight that example. So if you took someone that's in receipt of, let's say, the full age pension, and they also then sit and have money sitting inside super, so their effective marginal tax rate, they're on the lowest tax rate once you take into consideration rebates and other things, and then they hold some assets that potentially not generating a significant amount of income. Then then the CGT, it'll be where does that put them in the tax scale, and then that's the tax that they'll pay on the realised real gain from an indexation point.
Yep. All right. Well, we're probably stating the obvious here, but what we wanted to try and show you is this comparison around what the new rules are going to ultimately look like. So what we've been able to do is we've started to build some tools that could look to model these things. So understanding the impact of being held individually and looking at different tax rates based upon taxable income, looking at that family trust arrangement where we'd have the 30% minimum tax, looking at considerations around holding in a company and both accumulation and pension. So in very simple terms here, you can see some of the assumptions that were built in around, say, $100,000 cost base, its current market value with some growth and some income, some inflationary adjustments, the hold period, and the income levels of individuals A and B. So what I'm going to do is I'm going to move across to the actual files that we've built here, just to show you. So we've included the extracts in the actual slides here. But what this will enable people to do is to effectively start to model out what this will actually look like from a comparative standpoint. And what becomes quite obvious here is the benefit that you end up with within a superannuation environment. So whether there's tax in the fund where it would be taxed at 15%, but we would end up with a discount, so bringing that tax down to around 10%, versus that post-pension phase sale, which again, you can see the difference here as that gets graphed around what that CGT looks like. So we're going to build out a range of these models. In particular, these will be incorporated for our members. We might sort of put something around others to be able to access via our platform. But it just goes to show and highlight what the benefits of superannuation are going to look like. And then based upon the growth rates and so forth, the compounding benefit that you'll see over time and the time frames for how long we're holding those assets and what that might mean with clients as well. So again, we've just shared some of this information and some of that result of those different outcomes in here, and you can go back and sort of understand that a little bit further with the CGT comparison. Now, of course, what we have put in here is that this doesn't factor in the Division 296 tax stuff at the moment. And quite clearly, that is going to play a role here. And we're going to talk about that more shortly when we get into the trust distribution discussion, because ultimately we know that's where a lot of the money was going to be leading to for those that wanted to exit as a result of those particular laws. But this was just a highlight for those that are making some key decisions around, well, where should I be making my investments going forward? Understanding what the Labor government has proposed through the budget, you can start to highlight to your clients what that might look like based upon the alternate structures. So, Tim, let's move now into the negative gearing section and the impact that this is going to have, and specifically around the use of LRBAs ultimately within SMSFs. We don't really focus on the context of negative gearing inside superannuation. We utilise borrowing and leverage, but typically we see the income of the fund positively geared, and that debt and the interest cost is in essence helping to fund a reduction in the contributions tax.
Yeah, and so I think, and what we want to make clear is that, as you sort of alluded to there, is that negative gearing from an SMSF point of view is, of course, it's a thing, right? There would be funds that engage in certain levels of negative gearing, but it's not something that's spoken about, more broadly from an investment strategy point of view to a significant extent, right? And so the negative gearing changes from an SMSF point don't necessarily impact funds from an operational point of view, and they definitely don't impact super funds from an operational point of view because they've been excluded from the negative gearing measures. But I believe, or I feel, that they've been excluded because negative gearing isn't ultimately something that plays itself out significantly in the SMSF space. And a lot of that is around the borders and boundaries linked to limited recourse borrowing arrangements, the maximum 70% LVR type rules and other things. And so what it's really about, what these measures are really about in the conversations you and I have had, is more about where those investors will look now from an investment property point of view, whether or not there's value in doing it inside super and potentially utilising limited recourse borrowing arrangements, or whether they maintain investments outside of super. And of course, for those with existing properties and under existing negative gearing rules, they're going to probably maintain the status quo as such. But when we're looking at new investments, because not everyone is going to do a new build, right? Not everyone's going to engage in a new build, and particularly because certain things like the new build rules are quite interesting. You can't just knock down a house and rebuild it and say, I've got a new build, so give me negative gearing. You've got to replace like with unlike. So if you're going to knock down a house, you've got to build a couple of townhouses or do something else to be able to engage there, or build on vacant land.
Yeah, which becomes a problem, obviously, in an LRBA context anyway.
Correct. So there's certain areas where it's not going to be within scope to look at these processes using self-managed. But of course, we don't have to just talk under the guise of LRBAs. There are cash-rich funds as well that might look at it, and they might look to subdivide land or other things, which is all quite possible. And so when we start to look at it from a planning point of view with our self-managed superannuation funds, what we are addressing really in this space, we go back to the commentary we made before, where a couple, for example, can contribute up to $1 million or just over $1 million over a 2-year period, June, July, subject to having less than that 1.84 million. So it creates a significant wealth pool to be able to then look at making property investments inside the super environment with that lower tax rate, with the final goal being, okay, well, from an end tax point of view, so not even looking at the rental incomes and things, but from an end tax point of view, the maximum tax is going to be 10% on the sale of that asset. Subject, of course, to getting everything right and not invoking any gnarly provisions along the way, because that's the worst case scenario, is telling your clients to move from a trust or whatever else at 30%, move it into a self-managed super fund, and then motor along with expenses that are non-arm's length and end up paying 45% tax. So that's worst case.
And taint the asset permanently along the way too.
Yeah, that's right. But the idea that you can look at making those contributions, but similarly look at, okay, well, can we lend money to the superannuation fund if we're not up for the idea of permanently preserving benefits through a contribution? do we look at the proceeds of lending money to super under the related party guidelines? Yes, that generates income for the individuals from an interest point of view, but then is there a capacity to offset that with concessional contributions and subject to, again, carry forwards and other things? There might be scope in that time frame to be able to use a little bit more than the standard cap to offset some personal tax liability as well. And so really having that future vision of how holding property inside super, subject to the overriding sole purpose test and the fund's investment strategy, can actually be a huge tax or provide a huge tax benefit to investors.
Yeah, absolutely. And there's a couple of questions in here, obviously, just around the whether we look at refinancing of an existing property to get money to buy a new property, to retain the negative gearing. I think it's important to remember from that point of view that if the asset's already in the fund, you can't leverage that existing property. So any sort of funding needs to stack up on its own 2 feet. But I'm sure we're going to see a range of ideas get thrown out in this area, quite clearly off the back of the attractiveness that we see around superannuation getting structured. So, all right, well, let's keep moving, Tim, and let's look at this topic of a minimum tax on discretionary trusts here. And I know Jacqueline had a question around discretionary trusts being taxed at 30%, and the fact of whether you get a credit on the income when it's distributed to the beneficiary. And one of the things that has been highlighted so far is that if that distribution is made to something like a bucket company, then we end up with a double taxation event here. So where we might have filtered stuff across to a bucket company, and then we might have entered into a related party LRBA arrangement or something. That's certainly not going to be the case now, where effectively there's a 51% tax rate that would apply to those bucket companies, because that distribution that's coming across is ultimately a non-refundable credit, very different to the franking credit that we see with company structures. So Tim, I might get you just to run through this slide here around those new rules, and then of course the impact for our SMSFs and the planning opportunities.
Yeah, and I think let me start with the exclusions, obviously. So this whole concept around discretionary trusts, and look, I'm sure many people online and many of the presenters here present today have utilised discretionary trusts in some way, shape, or form to distribute income. I'll have to find a way to distribute that additional $500 a year I make between my son and myself. Not sure I can cope with the 30% on that. But the exclusions to the rules around fixed trusts and widely held trusts. The widely held trust piece is a more broader conversation around a lot of the various managed investment schemes and things, but certainly in the SMSF space, we do see a lot of funds that invest in fixed unit trusts. So there's still a piece to play out there around the earnings and things of trusts that are owned, so indirect trusts. We saw carve-outs with Div 296 and valuations and CGT resets around indirectly held assets. So where or how will trust income that is then distributable to a complying superannuation fund, how will that be treated from a credit point of view? There's some issues for us to contemplate, but what we will see is this concept, as you highlighted, Aaron, of the 30% minimum tax on all the discretionary trust income from the 1st of July 2028. So we've got some time here to work through this strategy. It's not a strategy that we're having to rush into making decisions with regards to allocation of income immediately. What we do know is that we've got from the 1st of July 2027 some CGT rollover relief. So we're going to have the capacity to roll assets out of those trust structures with a CGT exemption. So again, where we're looking at moving the assets potentially to a company, potentially to individuals, wherever it might be, or potentially to a fixed trust, There are certainly considerations there to do it inside the 3-year window that will exist from the 1st of July 27 to 30 June 2030 as our time frame there. But also what that then subsequently means is, what opportunities does that present from a planning point of view for self-managed super funds? And again, because we're about to touch on the Div 296 implications of a lot of these things, we've got to work within the bounds of the existing SIS regulations as far as things like acquiring assets from a related party. But what we can take into consideration is, all right, well, these assets were previously maintained in the discretionary trust so that we could split the income to get better tax outcomes. Is there an opportunity to move these assets into a self-managed super fund with reference to the ability to then have the income taxed at a lower rate? Are those assets then subject to SIS exceptions to the acquisition of assets from related party rules? How do we go about that process? Would the assets potentially need to be distributed out first to another structure before being transferred into the super fund? There's a little bit of area that we feel that needs to still be sort of worked through in this space. But it's going to, again, provide planning opportunities with the broader picture of discretionary trust tax versus ultimately Division 296 tax as to where the vehicle of choice is for holding these investments, because the number of trusts that are excluded is limited. And there certainly will be certain testamentary trusts and that which was announced as part of the budget measures with more information to come. Putting assets in a testamentary trust could also be problematic. So we've got to look at how and where to hold investments moving forward to generate the best tax outcome for our clients. And of course, there's going to be those clients who are not Div 296 clients, where super is going to continue to look exceptionally attractive from a taxation point of view.
Yeah, and Tim, I think it's important to remember that when we're looking at this CGT rollover relief for 3 years, CGT is only going to be one part of the story. Yep. Now, you've already mentioned that the SIS rules will be another part of the story around the assets that a fund may be able to acquire. It'll be fascinating to see, and I think I know the answer to this, as to whether the states around some of the relevant duties that may be attributable will be whether they might come to the party. My best guess is I'd find it highly unlikely. Me being the cynic in Victoria would find it hugely unlikely given the level of debt that we have. But again, we need to, in terms of the analysis of comparing apples with apples, we need to understand not only the benefit of what CGT relief might do, but what are the exit costs that would be attributable to that? And then is there a payback period that justifies actually entering into that transaction in the first place? And that actually then leads us on, because this is very much front and center now around what the opportunity cost would be, because discretionary trusts were going to be flavour of the month for those with high balances to move money out of superannuation because of the introduction of these new Division 296 tax measures, and very specifically for those that were above 10 million, where we know the headline figure was as much as 40%, so 15 at the fund level, and then a further 25, so 15 between the 3 and the 10, and then an additional 10 above the 10. And then, of course, the 15% or 30% headline where they were between the $3 and the $10 million. So this is where the modelling and stuff was going to become really important, because for those that were getting close to the $3 million, there was naturally going to be a range of strategies to give consideration to how money's getting into super, whether you're using splitting. Of course, NCCs were restricted once you get to 2.1 million from 1 July. You're looking at a whole range of stuff to try and avoid moving into that environment. But we now know off the back of moving that, if we were moving that money, if we're moving it out into an environment such as a trust, then we're going to have an entirely different set of circumstances because of the fact that we've got a trust rate that at a minimum of 30%, the fact that there's CGT changes that are incurring inside of that as well, which makes things look very, very different. And so what I'm going to go through here is to just explore how this impact and what this impact ultimately looks like. So again, we've just started to model out here a couple of ways and tools in which we can assess whether we do something or don't do something. So in the first instance here, what I'm focusing on is where we have someone that is above 3 but less than $10 million. And we might have a property asset, let's say it's a commercial property valued at say $2 million, or we're going to take $2 million out, and we have a member who is in a tax-free environment, so they're over 60, so it's not going to cost them from an income tax point of view, so they're getting the benefit out of the fund, any tax, because that income, that lump sum, that pension, whatever it is that they do is non-assessable, non-exempt income to them. Now, what we've got here is we've got an average rate of tax, because when it comes to fund tax, we know that very few funds pay 15% as an average rate. Why? Because we have things like ECPI, we have things like franking credits that will reduce that down. We also know under these rules that the minimum rate that would be relevant to the trust income would be 30, and it could potentially be higher when that's distributed out based upon the taxable income of those funds. So again, what you can see here is we can leverage here what the fund earnings are. We need to be very clear and distinct about the difference for Division 296 tax earnings. So why do we have that difference there? We have that difference because we may have made CGT elections, say at 30 June, that would reduce the value of the earnings to attribute Div 296. And then we have the alternate to say, well, if we're taking money out, what would the fund earnings look like? What would Div 296 earnings look like? And then we have the trust income that has been deployed from the SMSF across to the trust, and the 350 plus 150 matches us back to the $500,000. So what is interesting from here is we can start to see and model out the differences between the situation whereby the fund would be paying tax versus in option A versus option B, where the fund tax has naturally been reduced, but we've got a trust tax issue. So in this situation, on an $8 million, the super fund is going to be better off by about $16,500 here by virtue of the average rate of tax plus Div 296 being less than the 30% rate. So again, just starting to model this out, and you can see why this is changing and changing very quickly. Now, what is important to note here, though, is that this model, at this stage, at least anyway, doesn't factor in things like that transaction cost that we've been talking about. And Tim, the other really important thing here is we need to understand the taxable component of a superannuation interest, because that then does quite categorically come into the overall tax cost with a superannuation death benefit.
Yeah, and I think this has probably been, since the early days of Div 296, particularly when we just had a $3 million threshold originally. But one of the conversation pieces has always been, don't forget the old concept of death tax, which doesn't exist in Australia, except it exists in multiple forms, and one of those forms is PAYG, when you're paying to a non-tax dependent. Now, the reality of a lot of the discussions around Division 296 will be whether to revert or not from a pension point of view, noting that the reversionary pension will effectively impact somebody's total super balance straight away, and could have them liable for Div 296 based on the end of year balance when that pension reverts. So there's a conversation piece around reversionary pensions that is already in the discussions around the strategies moving forward. But the second bit is that because everybody dies, sorry to bring the mood down, but because of that very concept, it means that in a two-member fund, there's going to be a second death benefit, and that second death benefit is inevitably paid to a non-tax dependent. And so the conversation piece really moves to, do we pay the benefit out of super when the first member passes away, rather than maintain it under a Div 296 and avoid the death benefit tax if it's payment to a spouse, or do we leave it in and run the risk of not only having the enhanced Div 296 tax liability, but also the PAYG liability to the beneficiary, which the deceased isn't so concerned about because it's not part of their tax liability, but those that remain have to be mindful of it. So it's a very broad conversation that we have to have, which goes back to that point I was making before about TRIS and having multiple interests inside super with tax-free taxable components and other things, and how we plan for the inevitability of death from a tax point of view. And to take it off topic for 30 seconds or 15 seconds, that's where the recontribution strategy for those with less than that $2 million is still such a vital strategy to contemplate, because it might not, or it won't make you in the future potentially avoid Div 296 if, as you get towards 75 or whatever, you hit that $3 million mark. But if you can turn taxable component into tax-free component while you've still got the capacity to do it, then it's going to impact that broader tax position at the time of death.
Yeah, absolutely. Well, then I guess, Tim, the other part to this question is well, if we can start to see what that looks like for those below 10 mil, how does this impact those that are above 10 million? And so again, we've started to model this stuff out, and we've used 15 million here, and we maybe deploy out 3 mil. These are all variables that we can put into the model to actually start to look at this. I guess one of the key changes I've done here is the average rate of tax has been reduced substantially. A lot of this because of the age of the members and the ECPI that would be relevant in this fund. There would be both pension and accumulation interest in here. I've got a higher level of income, but I also have a higher level of Div 296 tax earnings because we need to add back net ECPI for Division 296 tax purposes. So in this instance here, again, we marry out to the same numbers of SMSF earnings, but split between both trust income and SMSF-based earnings. But things naturally look a little bit different. The advantage here is that we actually take money out and we would pay the tax in the trust that you can see here, but the margins now have dramatically changed. And that, to me, really is the key message here, that you need to sit down and explore this in some detail with your client, because on 15 mil here, where we've dropped it down to 12, there's only about an $8,000 benefit in doing so. But again, those same transaction costs, those same considerations around death benefit tax and those sort of things are still absolutely and acutely relevant here in that context. So again, we're going to keep working on, in our own right, building out these sort of deployment decision calculators and factor in some of this stuff. We're going to be building this into our tools on the Smarter SMSF platform with a range of others that we've built out, including one for our upcoming tax planning checklist that we've built in an online form. So yeah, we'll be making all these available for you to have these robust conversations with your clients, because I know many people have had their phone ringing off the hook since about probably 8 o'clock, Tim. It wouldn't be 7:30, but at probably 8 o'clock on Tuesday night. So let's keep moving and look now at the key planning opportunities, Tim, here for SMSFs, because what we've highlighted, and I'm sure many of you have been reading, because most people through financial services media and media generally have recognised the fact that superannuation is the one that really hasn't been tinkered with, and therefore redeploying and reconsidering how we use superannuation has become front and centre.
Yeah, and so and we've already talked about a couple of these through the presentation, and And these are really just sort of what we've identified. And there's probably more than 5, Aaron, too. You know, this is sort of our starting point here. And as we've spoken about there, you know, where we should be holding assets, right? So, and I think that's a conversation that, you know, people wisely should be having all the time anyhow, as to where they hold it. But with the new CGT rules coming into place, I think it has greater scope for that conversation. And you know, I think one of the questions or one of the comments before was around, you know, did we see the negative gearing changes potentially coming into super at some point in time in the future? I guess the question can be asked about CGT changes. Do we assume that that what's been introduced this year will remain the status quo? I don't think we can ever assume that, because the environment changes at least every 10 years, you know, if not more frequently. And so, you know, it's what's best for now when we're looking at where to potentially hold assets. And part of that whole concept of where is it best to hold assets comes down to our ability to do things like make contributions, you know, and recognise that, particularly in light of Div 296, once money's out of super, if you're worried about Div 296, it's because you've got a high balance. Once that money comes out of super, you have very little opportunity outside of downsizer contributions, really, to put that money back into super because of your general transfer balance cap. So the question really now is, should I hold money that's already outside? Should I keep it outside, or do I look to putting it in? Versus the immediate question of, should I pull it out of super? And of course, really 30 June 2027 is going to be a key date for so many things, I think, Aaron, in that regard.
So I think just on that point, I think that's a really, really important point to get home. So clients that have been eager to move, and most of you would have been hopefully pushing clients previously on the fact that we need Division 296 to become law before we do so, would now also be pressing on clients the importance of the impact of this, but also recognising that we want to get some law around these items as well, because, again, those that have moved money out already, where they've moved that into a trust, for example, and the outcome can be modelled that they're going to be worse off, 99 times out of 100, they're going to be prohibited from getting that money back into superannuation by virtue that their total superannuation balance is above the general transfer balance cap.
Yeah, that's right. And so, so then, you know, the nuances of a lot of this stuff, in specie contributions, you know, are you moving money from one structure into super via in specie? Can you do it under the Section 66 acquisition rules? And then, similar to our property gnarly comment, are you doing it correctly? Like, are you understanding the market valuation requirements? Because all of that's critical to ensure that you don't impose that top marginal rate, which is what we're trying to avoid in the super space. And you know, probably that last point there, the pension timing thing, I think is critical, not just from a TRIS, which is a non-taxed environment or a taxed environment, but that full condition of release environment where we then move into the 0% tax plays up to potentially the general transfer balance cap is hugely significant.
Yeah, absolutely. All right. Well, we've included here just a few dates for people to be aware of, so we won't spend a lot of time on that. Tim, let's just sort of finish things off here. So one of the items here, we did see, this was a commitment that the Labor government gave the Greens originally on version 1 of Division 296. So do you want to just give a quick summation of that before we sort of wait on the final thing that we seem to just roll year upon year upon year in our budget update on SMSFs?
That's right. There's one slide that we just don't have to ever change, or except the year. So the paid parental leave, obviously, as you just highlighted, was something that the Greens fought for, and having the super guarantee incorporated on that paid parental leave. And it was a measure that got passage, but it originally got passage, and I think it was based on a 24-week payment option for how long the government increased or paid the super guarantee for. Now, in the original measure, there was an expansion of that from the 1st of July 2026, which said it would then be paid out for 6 months. So the 26-week period, that's just been reconfirmed. So ultimately, the position that we previously had has been reconfirmed with regards to paid parental leave, that we moved to a 6-month government payment following the 1st of July 2026. Residency. Look, I don't want to say when this actually all started, because in my mind, it actually started for me back in 2006, 2007 with a submission I did back to the government. Nick Sherry, I think it was back in the day, or actually pre-Nick Sherry, so Peter Costello days, changed the residency rules for self-managed super funds. It's been raised every few years. It's been reviewed with regards to income tax issues and central management and control and other elements like that. But the one fix, which we all think is probably the easiest fix of all, is to change the definition of an Australian super fund around the central management and control 5-year rule, but more importantly, the active member rule. And as it currently stands, it's still a problem for self-managed super funds, and there was no mention of it in the budget this year.
So, Tim, I guess the question here that some people might be asking is, well, why do we keep raising it? And the answer to that is because the government still remains committed to this, and they have previously said that they remain committed to it. And it's only until they decide, in essence, to strike it off, will we stop talking about it. And I think, as you said, it's the easiest fix because we just take one of the limbs effectively out of this and allows us to effectively have the exact same status as all other superannuation funds. So yes, I share your frustration, but there's not much we can do about it at this point in time. So
no, but it's important to recognise that in theory the legislation as it stands means that if you make a wrong move, i.e. an overseas one, and contribute to super, then the tax ramifications are quite dire.
Yeah, absolutely. Well, that takes us to the end of today's session. We'll spend some time having a look at some of the questions now, but a reminder that we do have a number of other sessions coming up, including our SMSF tax planning session. Everyone that's attended today, we will, for those that are not members, we'll send you a coupon code as a special thank you for joining us today to join us for that upcoming 1.5 hour session. And we're also going to demonstrate our new live online tax planning checklist again, which will be available through our Smarter SMSF platform. So a big thank you to everyone that has joined us today. If you want to hang around and sort of listen in to some of these questions, please feel free to do so. But I do recognise that it is 1 o'clock our time here, or 12:30 for you, Tim. So a special thank you for joining us for today's session, and no doubt we're going to be talking about many of these things for not only the rest of the year, but for the coming years ahead. So have a great rest of the day. Take care and bye for now.
See you all.